All right, so now we're going to talk about an indices or an index. We talked just now about the S&P 500, the Dow Jones Industrial Average. So I like to, as you know, I like to go as much as possible and grab information for you from websites that you can visit. So I went right to Investopedia. Actually, I Googled it because I always want to see what's best, but I really like Investopedia. It is for general descriptions or definitions of different market tools or activity, things like that. So Investopedia says, what is an index? An index is a method to track the performance of a group of assets in a standardized way. Indexes typically measure the performance of a basket of securities intended to replicate a certain area of the market. So let's look at the Dow Jones Industrial Average first. So I'm going to pull these up. So I'm going to actually put this down like I typically do. So you may see the top of my head and I'll be looking down, but I'd like to be able to draw on these. So let's talk about the Dow Jones Industrial Average. So what is the Dow Jones Industrial Average? So the Dow Jones Industrial Average is 30 individual companies chosen for stability of growth and earnings. I'm reading a definition. This established in 1896 by Charles Dow and Edward Jones at just 12 companies. This has changed 51 times since 1928. The Dow components are chosen by S&P Dow Jones indices. There are no specific rules for inclusion. Generally speaking, components of the Dow should be large and respected companies. However, they aren't the 30 largest companies in the market, a common misconception. So you'll often hear me say when I refer to these indices, this is roughly the largest companies in the US, so this is 30 of the most respected, should be large and respected companies in US, right? These are definitely United States industries, but of course, they can have effects globally. All right, I'm missing and let me share with you, this is a good site. There's a lot of ads on here, but I'm dragging this down. So this is Slick Charts. So this is really, really basic, but it's a good charting system. If you just want general information on really just stocks. I haven't found anything on here that has anything to do, with bonds. But here's, for example, we're talking about the Dow Jones Industrial Average. So, of course, you see what the Dow is doing right now, and you can go into the Dow and you can look at annual returns. I'm over here on the right. Annual returns, performance, year-to-date return, dividend yield, index analyses, and this talks about the 1929 crash. But let's go in and look at the companies, and this is a free site, as you can see by all the different ads, and you can see that I've been looking for a rental car in Las Vegas when I'm out there because that's what's popping up. So let's take a look at the different companies in the Dow Jones Industrial Average. And these are price weighted. So it's depending on the price of the company, the market price. And you can see how it works here. Here's the price of United Health Group. Now, of course, none of these, I have to disclose, none of these are any recommendations, especially if you're just joining us via YouTube for this topic. And again, if you are, just subscribe for me, hit the like button and your notification button. But any of these companies that I'm showing here, it's not a recommendation to buy, sell, or hold any of these companies. So United Health Group here, you can see that that has the largest price, and then it scales down. So this is price weighted. And then you have Goldman Sachs, Home Depot, Microsoft. I kind of want you to just take a snapshot of this in your mind. McDonald's, Amgen, Visa, Honeywell. So you'll see that even if you focus on the top 10, these probably aren't any surprises for you. Now, that's the Dow Jones Industrial Average. Now, we often hear about the S&P 500, and we'll get there in a moment. And you see that over here. So, and I told you that the returns for the Dow Jones and the S&P 500 aren't exactly the same, but they tend to track pretty closely. I mean, there's sometimes the S&P is higher or lower than the Dow, but you'll see why in a few minutes. The S&P 500 or the Standard & Poor's 500 index is a market capitalization weighted index of the 500 largest U.S. publicly traded companies. companies. The index is widely regarded as the best gauge of large company U.S. stocks, whose components are weighted according to the total market value of their outstanding shares. So that's what capitalization means. S&P 500 is price weighted. Whomever has the highest price, they have the highest place. This market capitalization is based on the company's number of outstanding shares, the market value of their outstanding shares. So you'll see here, and if we go into the S&P, so this is the Dow. Let's go into the S&P 500. So here's where you'll see market capitalization: Apple, Microsoft, Amazon, Tesla, Alphabet, that's Google, Berkshire Hathaway, United Healthcare, United Group, right? So there's a repeat there, but you'll see that United is I don't know if it's the highest price in the S&P 500, it might be, but it comes down at number 8 here. Johnson & Johnson, Exxon, Meta, right? So that's Facebook now, JP Morgan. So you can see that there are some similarities there. They're weighted differently though. Now, one of the other ones that we talk about is the Russell 2000. So the Russell, and again, these are non-managed indices or indexes. So these exist out there, and we compare money managers to them. So if we talked about the S&P 500 being the best gauge of large company, large US companies. So if I hire a manager or a mutual fund to manage that portion of my money, I might compare them, being large company US stocks, equities again equals stocks. I might compare them to the S&P 500. And if the S&P 500 returned 10% and that money manager or mutual fund did 11%, then they have some value over just owning the S&P 500 as an exchange traded fund, which is something we talked about a few weeks ago. And you know, on the other side of it, if the S&P 500 fell, 20% in a year, and that money manager, mutual fund or individual money manager, only fell 15%, then of course that's an added value as well. So these are the things that we use these indices for, is to compare how people are doing when they're managing our clients' money. So they're referred to as benchmarks also. So you might use the S&P 500, which you just learned about, as a benchmark to your investments or how a manager is doing for your investments. So I hope that makes sense. Another one is the Russell 2000. So the term Russell 2000 index refers to a stock market index that measures the performance of 2,000 smaller companies that are included in the Russell 3000. I know that's a little confusing. Generally, the Russell 3000 is a broader market index that includes smaller companies and larger ones like the S&P 500 and the Dow. So again, the S&P 500 and the Dow tend to be much larger companies. Now we're getting into the Russell 2000, which is small and some mid-sized companies. The Russell 2000 is managed by the London's FTSE, or what we call FTSE Russell Group, and is widely regarded as the bellwether of the U.S. economy because of its focus on smaller companies that focus on the U.S. market. So they're saying that the smaller companies tend to drive the future of the U.S. markets. Many investors compare small company mutual funds against the index's movement, and we talked about that, as it's seen as a reflection of opportunities in that entire subsection of the market, the narrower indices. So let's look at, oh no, do we not have the Russell here? Okay, I can't show you the companies in the Russell 2000, but I can show you now the Nasdaq 100. So the other big one that we see, right, it's right here, Nasdaq 100. Is another big one. So the Nasdaq 100 index is a basket of the 100 largest, most actively traded U.S. companies listed on the Nasdaq stock exchange. So this doesn't represent all of the Nasdaq, just roughly the top 100. The index includes companies from various industries, except for the financial industry, like commercial and investment banks. These non-financial sectors include retail, biotech, industrial, technology, healthcare, and others. The index is uses a modified capitalization methodology. This modified method uses individual weights of included items according to their market capitalization. Weighting allows constraints to limit the influence of the largest companies and balance the index with all members. So it's kind of a blend. It's not really, but it's more of a blend between price weighting and just market capitalization. It's the idea of the Nasdaq was, let's give it a more fair weighting. So let's look at what's in the Nasdaq 100. And I hate all these ads. But Nasdaq 100 companies are, yeah, I did switch that. Let me go back to the S&P 500. And this is what I said, take a snapshot, a mental snapshot of what's in your head. And that's why you see some of these indices operate the same way. With the S&P 500, this is the S&P 500, right? Companies by weight: Apple, Microsoft, Amazon, Tesla, Google. Let's switch into Nasdaq. Apple, Microsoft, Amazon, Tesla, Google. So one of the things that we saw coming out of the pandemic was we really had 5 or 6 companies that were driving most of the market. And you're looking at them right there for the most part. There were some others too, but there were a small number of companies that were driving. So of course, when there is a market adjustment, it likely will fall pretty quickly. All right, lost my monitor again. Okay, so they are indices. So let me just recap there. So we talked about the Nasdaq 100, we talked about Russell 2000, we talked about the S&P 500 and the Dow Jones Industrial Average, and how these indices are made up, how they're weighted, and what they're used for. So they can be used to just purchase these broad markets. And we have these things called exchange traded funds now that you can purchase, that you can buy the entire S&P 500 with one transaction. Very, very simple. They can be efficient. They can be very, very cheap. You can probably buy the S&P 500 through Vanguard. Again, not a recommendation. And the fee on that would probably be somewhere around 0.03%. You've got to be careful when you're purchasing exchange traded funds to track an index, to make sure that they're accurately tracking that index, because there is a drift that we often see with ETFs or exchange traded funds, where the returns will be significantly high, below or above what the returns of the index are. All right, that's your financial planning topic for the week. I do see a question, so let me stop my share and adjust my tablet and see what the question is. All right. Most managers historically fell short of S&P 500 returns, Gerard writes. Yeah, Gerard's right. So unfortunately, most of the, I say this often, most of the investment managers, whether they're individual money managers or mutual funds, are either mediocre or stink. There's a very small percentage, and it's about 8% that can routinely beat their index. And that's why ETFs have become so popular, because people say, why am I paying anything for a money manager to underperform, much less 1% or more? You know, when I first started in the industry, the average fee was about 2.25%. So that's changed quite a bit, but good point, Gerard. All right, folks, that's it for today. I look forward to seeing you next week. Next week, we will have a webinar, but the following week, we will not, because I'll be in Las Vegas visiting my friend Ed Slott. Looking forward to seeing you all soon. And please answer the survey that follows this, and email me with any questions you have. Have a great week. Take care.